Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1216A, and today's date is February 28th, 2017, and the title of the episode is, Last Time We Saw Credit Seize Up, We Were in a Recession. Well, it's happening now. Now, before I get started, I just want to make an announcement. I uploaded an interview with Simon Black. He's from sovereignman.com. If you go over to the X22 Report Spotlight YouTube channel, you'll see the video there. Or you can come over to the X22Report.com site, scroll down a little bit, look over to the right-hand side, you'll see the video there. Or you can go to newssentinel.com, same thing, scroll down a little bit, look over to your right-hand side, and you can play the video there. Let's get into the economic collapse financial news. Now, out in Greece, we talked about how people are taking their currency out of the banks, and what we're seeing right now is that this is accelerating. It is not slowing. People are continually taking more and more of their currency. And what we're seeing right now is that bank deposits, they've tumbled to the lowest since 2001 in the banks. And the situation there is getting worse. And this is why they said, listen, we can't do bail-ins right now in Greece because it will hurt the creditors. And what's happening is that the outflow of currency, well, it's making it very difficult to do bail-ins. And people realized this. They understood what would happen because they looked at Cyprus and they knew that if they keep their currency in the bank, it would be trapped there. So this made it more and more difficult for them to do a bail-in. And again, my personal opinion is only keep as much as you possibly can in the bank, because if we get into, or when we get into that bail-in situation, guess what? We're going to have a bank holiday. The system's going to shut down. You will not be able to get your currency. It will be stuck in the bank. There'll be capital controls that will be put into effect, and you will not be able to get any of your hard-earned currency. Now, I would personally keep currency on hand. I would keep gold and silver as an insurance policy. We can see right now that the former Fed Greenspan, he's saying, yeah, I would keep gold as an insurance policy. Countries now are loading up on gold, so I would do the exact same thing. Now, in almost 20 states right now, we see that they have raised the gas prices. Remember when the gas prices came down? Well, our government officials thought this would be a perfect opportunity to raise gas taxes. And we can see that nearly 20 states, well, they've raised gas taxes or recalculated the gas tax formulas, hoping that no one would notice because the price of fuel is much lower than it was. And we can see right now there are many states that are adding on 30, 40 cents or more than 40 cents to the fuel out there. Now, what's going to happen is that as people pay more and more towards fuel, well, guess what? This is going to hurt once again. It's not going to make the situation better. It's almost like the soda tax in Philadelphia, where they thought, oh, let's put a tax on this. We're going to get all this new revenue. And then all of a sudden, well, things started going the other way. People bought less soda, hurting the distributors, the bottlers. And we can see right now, this is what's going to happen. I mean, right now, the demand for fuel is declining. And once this gas tax goes into effect, and many states it already has, the demand's going to sink even lower. It's going to be a horrible situation. We see that GM, well, it looks like they're doing exactly what they did back in 2008. When things go bad, what do? You give out incentives, because incentives surge to over 80%. Now, we understand that we're in an auto bubble. We understand that the delinquency rate is moving up and up and up. It's not getting better. And when we look at the subprime securitization book, we see that in January of 2017, delinquency rates, they're soaring to the highest level since 2009, early 2010. And this does not look good. Meanwhile, looking at GM subprime data going back to 2001 implies historical spikes in 2-month delinquency rates is fairly decent indicator that all is not well. And what we see now is that GM is offering these massive incentives. And guess what? They did this before, and the company went bankrupt for it. I mean, discounts are averaging about $6,996 for like the Chevrolet Silverado, $5,315 for the GMC Sierra. And when all this is said and done, this is not going to turn out well. We saw this back prior to 2008. And we know what happened to the auto industry. It was a complete disaster. Now, a couple months ago, we know that the government officials were out there and the corporate media was out there saying, yes, minimum wage, let's raise it up. Let's do this. This is going to help the people. And people were going back and forth saying, yes, minimum wage will help, minimum wage will not help. And we're starting to see the case where minimum wage is actually not helping. Now, remember, the value of the dollar is declining. If we do not go to the source of the problem, which is the central bank raising the minimum wage over and over and over, is not going to help. We've done this since 1970. Do you see any improvement at all? Or have things gotten a lot worse? And what companies are doing today, like Wendy's, like Walmart, Home Depot, McDonald's, they're putting in robots, self-checkout systems where they don't need people. And guess what? Wendy's right now has figured out how to eliminate 31 hours of labor per week from its restaurants. Because they looked at raising the minimum wage and they said, well, wait a minute. Can we afford this? No, we can't. Or maybe we can afford it, but we want to make more profits. Let's bring in these self-checkout terminals. And this is what many of the companies are doing. And if you notice, those are growing while the people actually checking you out is shrinking right now because they realize, let the people check themselves out. We need one person standing there that can handle 5 different kiosks, and we don't have to pay 5 people. That's exactly what they're doing. We see there's a retail apocalypse going on right now. Now, we've been tracking retail quite a bit here, and we know that retail is completely suffering. And it's not because of the weather. It's not because people are shopping online. It's because people don't have work, and if they do, they're making a lot less than they were once before, and they're holding on to their currency. And what we're seeing right now is that in 2016, it was a very rough year for the retailers. And we see that Aeropostale, Pacific Sun, American Apparel, and many others, well, they went for and they declared Chapter 11 bankruptcy protection. Sports Authority, same thing. Now, according to Moody's retail credit analyst Charlie O'Shea, the environment for retailers in the U.S. is likely to get worse before getting better. Moody's notes, the number of distressed U.S. retailers has more than tripled since the Great Recession. So what kind of recovery is this? Not too great. And with $5 billion worth of debt maturities over the next 4 years, the situation is going to get much, much worse. So who's next where they're going to be declaring bankruptcy or we're going to see stores closing? Well, Claire's, J. Crew, Tops, Route 21, well, they're all having problems. The 19 retail portfolio owe roughly $5 billion in debt through 2021, with about 40% of this due by the end of 2018. So we're moving into a situation where we're going from bad to absolutely awful. And as we move forward, it is not going to get any better whatsoever. We see Shiller is out and they're saying, well, mortgage rates are rising, but that's no problem. Home prices in our 20 cities, they are doing very well. Well, not really, because when you look at the graph of the Shiller home price year on year, remember they're only looking at a certain number of cities. They have been really flatlined since 2014. They hit their height in December of 2013. Since that time, they've been declining, and they've been flatlined since June of 2014 to the present day. And what we're going to see is that these prices are going to come down even further. Now, when we look outside of the 20 cities, guess what we see? Houses on the market. They can't sell them. Prices are being lowered and lowered and lowered. We see they finally came out with the 1.9% GDP for the fourth quarter. And again, this is a manipulated number. Obamacare premiums are included in this because this is part of consumer spending, which makes up 71% of GDP. They revise numbers going backwards to bring this number up. And this is what they do very often. They do these type of things to completely make it look like the economy is improving. But we could see throughout 2016, GDP is at 1.6%, which is actually awful, and it is a manipulated number, which means that this GDP number is much, much lower. If we go to shadow stats, we can see that GDP is in the negative territory. Now, back in 2008, we had a credit crisis where credit completely froze up. Today, we're seeing the same things. And when we look at commercial banks, all their loans and leases and things like that, we see from the Board of Governors of the Federal Reserve, well, they're at their 25% peak of the prior credit bubble in October of 2008. Since the week ending December 7th, 2016, they have declined a smidgen. So why is that all important? That this has flattened out after soaring for so many years? And how do these companies fit into this problem? Well, the period from October 19th until now is the first extended stretch of a stalling commercial and industrial loans since the bottom of the financial crisis. Now, commercial and industrial loans have been moving up and up and up until October 19th. And here we are in February. And we can see at this point what is happening is that we're seeing it turn down. Now, when we look at this, we say, oh, what's the big deal? Every time the credit stalls at the peak, we are in a recession. If we go back to 2008, prior to 2008, we hit a high of commercial and industrial loans of all commercial banks. It hit a peak and it started to decline. We were in a recession. If we go back to 2001, the same thing. If we go back in time, we see the same thing happening. So, going back to 1988, covering the last three recessions, the turning points show that we're in a recession, and that is what we're seeing right now. It is happening again. It's an early warning sign of a gradual change in the dynamics, and this is a red flag showing us something is happening. And we saw back in 2008, credit froze up. Guess what's going to happen again? Credit is going to freeze up completely. Now we see that the central banks, it looks like they have unleashed inflation. We're seeing that Spain, well, they reported a year-over-year 7.5% jump in inflation. Germany's seeing the same thing. The U.S., guess what? Inflation is over 2%, heading towards 3%. And it's moved up just right at 3% right now. And it's moving up very fast. And the big problem with inflation, it's like ketchup in a bottle. You know, it's hard to get out. You hit it, you shake it, and it just doesn't come out. But when you get it going, you can't stop it, and it just gets all over the place. This is what's going to happen with inflation. The Federal Reserve, the other central banks, they were trying to get it started. We know it was happening in the background, but now they unleashed it. And it's going to move very, very quickly, and they will not be able to control it once it gets out of whack here. And we can see that's coming very, very quickly. We see Marc Faber, he's out there saying that, well, the markets are going to fall like an avalanche. So we have David Stockman, Marc Faber, Charles Nenner, we have Cliff High, Harry Dent, all pretty much saying the same things, that this economy is going to come down. It's going to come down hard. And remember how it was in 2008, where you saw on the news people leaving their jobs, carrying boxes. people wondering how they were going to survive. They lost their pensions. They lost their wealth. They lost their homes. Well, we're going to see the same thing happen once again. But the central banks, the U.S. government, they didn't make it better. All they did was patch what was happening in 2008. And they pretended, they create this illusion that everything was fine. And when it hits, everything won't be fine. Why do you think they came up with the bail-in documents? Why do you think they've been preparing for this? They know exactly what's going to happen when the system comes down. They know and they're ready. They've just been keeping everyone else in the dark. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.